Hi everyone, are you ready to start trading CFDs? One needs to master effective strategies to succeed. This video course aims to equip you with the knowledge and skills you need to navigate the constantly shifting CFD market with ease and confidence. Let's begin exploring the possibilities of CFD trading. Contents list. Understanding CFDs, CFDs trading methods. Why adopt a CFD trading strategy? Managing CFD trading risks. Conclusion. Comprehending CFDs. Contracts for difference, or CFDs, are financial derivatives that let traders profit from changes in the prices of different underlying assets without owning them. Stocks, commodities, indexes, currencies, forex, and even cryptocurrencies are examples of these assets. In essence, when you trade a CFD, you and your broker enter into an agreement to swap the difference in an asset's price between when you start and close your position. Making money off price changes is the fundamental idea of CFDs. You start a long position if you think the price of an asset will rise. On the other hand, you initiate a short position if you expect the price to drop. The difference between the CFD's opening and closing prices determines the profit or loss. A flexible platform for a range of trading tactics is provided by CFD trading. Depending on their financial goals and risk tolerance, traders can select between long-term position trading and short-term scalping. Here is an overview of some typical tactics. Trading in news, profiting from market responses to noteworthy news events, is known as news trading. Traders might position themselves to benefit from the ensuing market swings by predicting how news releases will affect asset values. A variety of tactics based on various kinds of news are included in news trading. Even if political pronouncements have little effect on currency pairs, some traders may prioritize them over economic data releases. Furthermore, some traders focus on the earnings season and specialize in trading stock earnings releases. News-driven volatility can be triggered by a variety of events, including natural disasters, corporate earnings releases, political developments, and economic indicators. Traders need to be able to respond swiftly to breaking news and have a deep awareness of market dynamics. Because of the quick and erratic nature of market reactions, news trading carries a higher risk even though it can present profitable chances. Technical evaluation. For many traders, technical analysis is the foundation of CFD trading. To find possible future price trends, it involves analyzing historical price movements and patterns on a chart. This approach does not require fundamental analysis because it presumes that the asset's price already considers all pertinent information. To identify possible indications for entry and exit positions, traders use a wide range of indicators, including moving averages, RSI, and Fibonacci retracements. Scalping. The goal of the high-octane trading approach known as scalping is to make money off of tiny price changes. The goal of scalpers is to make a lot of deals with a little profit on each one. Access to high-speed execution platforms, a thorough comprehension of market microstructure, and lightning-fast reflexes are necessary for this strategy. Because it can result in quick losses if transactions move against the trader, scalping is dangerous by nature. It requires a high level of volatility tolerance and a solid risk management plan. Trading positions. With a long-term outlook, position traders hold onto their holdings for weeks or even months. Position traders profit from longer-term market patterns as opposed to day traders' short-term emphasis. They seek to find assets that are positioned for long-term growth by ignoring transient price swings and focusing on fundamental analysis. This approach requires perseverance, self-control, and a thorough understanding of market dynamics. While instant returns may be less frequent, position trading can be a wise option for investors aiming to create wealth over a long term. Trading by day. Trading necessitates quick decisions and close attention to the market. By opening and closing positions during a single trading session, traders profit from transient price swings. To spot short-lived opportunities, traders mostly rely on charts, indicators, and patterns, making technical analysis crucial. Rapid execution and a thorough comprehension of market dynamics are necessary for this high-octane strategy. Because day trading is short-term and requires continual attention, it bears higher risks even when there is a chance for significant returns. Why apply a CFD trading plan? A flexible method for negotiating the intricate and ever-changing financial markets is provided by CFD trading tactics. Traders can enhance their order execution, get more consistency, and even boost their total profitability with a clearly defined strategy. An organized framework for assessing market circumstances, spotting trading opportunities, and controlling risk is offered by a well-designed strategy. By adopting diverse techniques, traders may adjust to varied market circumstances. For instance, a position trading strategy might work well in calmer markets, while a scalping strategy might be appropriate at times of extreme volatility. Furthermore, a diversified trading method can be produced by mixing several strategies, which may help to reduce risk and enhance overall performance. Any trading strategy's ultimate objective is to maximize gains while reducing losses. By carefully choosing and putting into practice the right tactics, traders can improve their chances of winning in the cutthroat world of CFD trading. Managing the risks of CFD trading. Although there is much potential for profit in CFD trading, there are hazards involved as well. Effective risk management is a crucial component of sustainable long-term success. Traders must put in place a thorough risk management strategy that consists of being aware of leverage. Leverage can increase gains, but it can also increase losses. Traders should refrain from taking on too much risk and use leverage sparingly. Stop-loss orders. If the market goes against your position, placing stop-loss orders might assist reduce possible losses. These orders guarantee that, once the preset price is reached, the trading system will automatically initiate the execution of a closing market order, saving you the trouble of monitoring price changes. The triggered market order will probably be executed at or very close to the specified price in a typical market. However, the execution may occur at a price that is significantly different from the one that was originally specified during periods of abrupt market fluctuations or decreased liquidity. Orders for take profit. Traders can employ take profit orders to protect their profits. As soon as the price hits a predetermined target level, these orders automatically close your position. Diversification. One strategy to reduce risk is to spread your investments across a variety of asset classes. You may be able to balance losses in one asset with profits in another by maintaining investments in multiple markets. Preservation of capital. The 1% rule, risk per trade. Describe the risk management golden rule. Never put more than 1% of your entire cash at danger on a single deal, or no more than 2%. Use stop-loss placement to demonstrate computations. Position sizing. Describe how to determine the appropriate lot size based on the distance to your stop-loss and the risk level you have selected. Risk-reward ratio, ERR. Emphasize that trades must have a ERR of at least 1-2, meaning that you want to make twice as much as you risk. Understanding margin calls. Describe what a margin call is, which is when a broker requests additional funds, and how to use appropriate position sizing to prevent one. Volatility awareness. Talk about reducing position size and other risk-adjusting strategies during high volatility situations. Risk to the mind. Mind overtrading, revenge trading. Talk about the value of taking pauses and resisting the temptation to try to recover losses right away. Journaling. To gain insight from prior failures and achievements, promote thorough trade journaling. Testing your plan. Before implementing your plan in real markets, it is crucial to conduct extensive testing. To test your risk management strategy and replicate actual trading conditions, use a Forex CFD demo account. Keep an eye on your strategy's performance during times of market turbulence and change as needed to make sure it effectively preserves capital. Ongoing education. Risk management requires keeping abreast of economic developments, market trends, and geopolitical events. Ongoing education enables traders to make efficient trading decisions and react to changing market dynamics. You may raise your chances of long-term success and shield your funds from large losses by implementing these risk management techniques into your CFD trading strategy. Final results. For traders and investors, CFD trading provides a dynamic and possibly profitable channel. People can adjust their strategy to fit their risk tolerance, time commitment, and financial objectives by being aware of the several tactics that are accessible, ranging from short-term scalping to long-term position trading. However, there is a lot of danger associated with CFD trading, so it's important to do your homework, practice with a Forex CFD trial account, and put strong risk management techniques into place. By combining knowledge, discipline, and adaptability, traders can boost their chances of success in this hard yet lucrative market. Frequently asked questions. How can I trade CFDs effectively? Trading CFDs successfully necessitates a combination of risk management, discipline, and understanding. Begin by comprehending the fundamental market and asset dynamics. Create a clear trading strategy that includes take-profit and stop-loss orders, as well as entry and exit points. Use leverage carefully because it can increase both profits and losses. Long-term success in this ever-changing industry requires constant learning and adaptation. Are CFDs used by experienced traders? Indeed, because of their versatility and potential for large returns, professional traders frequently employ CFDs, contracts for difference. With CFDs, traders may make predictions about price changes without actually holding the underlying asset, giving them the chance to benefit from both rising and falling markets. Although it raises risk, the leverage that CFDs offer can improve profits. In order to maximize the advantages of CFD trading while minimizing possible losses, experienced traders employ sophisticated risk management techniques and in-depth market analysis. What is the most effective trading technique for CFDs? There isn't just one best way to trade CFDs. What is effective for one trader may not be for another. Market conditions, time commitment, and risk tolerance are some of the variables that affect success. Technical analysis, fundamental analysis, and risk management are frequently combined in successful tactics. Finding a strategy that fits your unique trading style and goals is essential, and you should constantly be ready to adjust as market conditions shift. Is trading CFDs suitable for novices? Because of its flexibility, the availability of sample accounts for practice, and the possibility to begin with modest initial investments, CFD trading is a good choice for novices. However, it has a high risk, particularly because of leverage, so novices must fully educate themselves and employ risk reduction techniques. Which trading platform for CFDs is the best? The best CFD trading platform depends on personal requirements and preferences. Several well-known platforms are as follows. MetaTrader 4 MT4, well known for its automated trading features, array of charting tools, and user-friendly interface. MetaTrader 5 MT5 provides more periods and order types, among other advantages compared to MT4.